In this video, we're going to talk about the new IRS guidance that just came out on how to take up to $100,000 out of your 401k without any penalties because of the pandemic. Now, before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. So the CARES Act has a provision that allows you to take up to $100,000 out of your 401k. Now, at first glance, taking money out of your 401k at any time before retirement is a bad idea. You should have your cash reserve and other sources of income and other securities to make sure that you can get through difficult times. But even if you haven't gone through your cash reserve, you might still want to consider taking some money out of your 401k because of the pandemic and the massive amount of uncertainty moving forward. Now, I want to be really clear on this. I'm not telling you that you should take money out of the 401k, but in certain situations, it's going to make sense to take a closer look at these new provisions. And even if you have all of your cash reserve and everything seems great, you still might want to consider taking money out of your 401k. And I'm going to tell you exactly why. But to understand the benefits of the CARES Act and this new IRS guidance, you kind of have to understand how 401ks work or the distributions work. Normally, if you want to take money out of your 401k before age 59 and a half, and 59 and a half is the age at which you can start taking money out of your 401k without the additional 10% penalty. Usually, there are other loopholes and ways to get money out of the 401k, but in general, it's 59 and a half. And in addition to that, there would be ordinary income tax. So it would be like getting a paycheck. So if you pull the money out of the 401k, you're just gonna tack it on to your taxable income. So you have a chance of getting pushed into a higher tax bracket. And if we compare this to the Roth IRA, the money that you put into a Roth IRA are called your contributions. Now you could take out those contributions out of a Roth IRA at any time for any reason, tax and penalty free. But what's different about the provisions for the CARES Act and the 401k and this IRS guidance is if you pull the money out of your 401k, while it's still taxable income, you're not gonna get the 10% penalty, but it's still taxable. But you have the opportunity of putting the money back. Now, if you took money out of your Roth IRA, you don't have the opportunity to put that money back. It would be an additional contribution in future years. So you'd basically be capped at your $6,000 contribution. Where in this case, if you took the $100,000 out of the 401k, you could put the full $100,000 back into the 401k and have zero tax consequences. And there are two ways to take the income from that distribution. So you can take it in 2020. So let's say that you took $100,000 out of your 401k, you can take that $100,000 and add it to your 2020 taxable income. Or you could take a third of it and pay it back each year over the next 3 years. So that would be for 2020, 2021, and 2022. Now, when you make the income election, which is the distribution, you can only make it one time. And it says it right here. This election cannot be made or changed after the timely filing of the individual's federal income tax return, including extensions for the year of the distribution. So once you make the election, which you're gonna do when you file your taxes for 2020 in 2021, that's gonna be set in stone. Now, there are just so many different scenarios that you can go through. For example, if your income is really down this year and you took some of the money out of the 401k and took the income in that year for 2020, but later on you decided, hey, you know what? I really want to pay this back, but you realize maybe financially you're doing significantly better moving forward, then you can actually just keep the money and then make normal contributions just at a higher rate. So if you're not usually maxing out your retirement plans, then you can just do it that way, where you're taking the income from 2020 and basically putting it on the other years. So without getting too technical, let's say you took out $30,000 and you decided, I'm not gonna pay it back to the distribution. So you're gonna take that income in 2020 and it's gonna increase your taxable income by the $30,000. But let's say that we fast forward for the next 3 years and you decide, hey, I'm doing much better financially. So what I'm gonna do is I'm gonna increase my contribution rate by $10,000 for each of the next 3 years. Then you can effectively reduce your taxable income in that year and since you already have the $30,000 in the bank, you could just use that money. Or in that same scenario, you can put the money back into a retirement plan and attribute it to the 2020 tax year. So then you would just need to file an amendment and it would reduce the taxable income. Now remember, I talked about making the election, and once you do, it's set in stone. What you can't do is take the income up front in 2020 and then make that recontribution in a later year to another way to offset those taxes. But the example I just talked about will allow you to do basically the same thing. And the other alternative is to take it over a 3-year period. So let's say that you took out the $30,000 in 2020 and you chose the 3 years to show the income. So what that means is you took the $30,000 out today, but you're only going to attribute $10,000 to each of the next 3 years. So in 2020, you're going to show a $10,000 distribution, which gets added to your income. In 2021, you're going to show a $10,000 distribution, which gets added to your income. And then in 2022, same thing. You're going to show a $10,000 distribution and you're going to add it to your income. Now for paying it back, if you choose, you can pay it back the same way you could with the 1-year election, but then it only gets attributable to those 3 taxable years pro rata. So that means 33%, 33 and a third percent gets attributed to the 2020, 2021, and 2022 tax returns. And even with taking the income and spreading it out over those 3 years, you don't have to make the recontribution over the next 3 years. You can carry the excess contribution forwards or backwards. So if you make it in year 2, in 2021, let's say you put all the money back, all $30,000 back, you'd attribute it the exact same way. You would go back and do an amendment for 2020 to basically wash away any taxes on the distribution of the 401k. And then you would take the other $10,000 from 2021 and go forward with it to 2022. Now, here's why I said that even if you have a cash reserve, you might want to still consider using this strategy, because it's kind of like another cash reserve. But after December 31st, you no longer have access to this penalty-free withdrawal from the 401k under the CARES Act and this guidance. So let's say that you even took the money, you didn't even end up needing the money, and you put it all back into the retirement plan. It would be as if nothing ever occurred, because whenever you're taking that distribution, whether it's in the 1 year, so it's all up front, once you put that money back, well, it's going to wipe away all those taxes that you already had. So it's as if you did nothing. And if you take the 3-year election, it's the same thing. You're basically just wiping the slate clean as soon as you put the money back into the retirement plan. Now, there are other technical parameters that you need to be aware of, whether or not your plan will allow it, because not all plans are allowing you to take the money out of the 401k, even though the CARES Act has the provisions, because they do respect some of the provisions that are already in the 401ks, which don't have these options to take the money out. And I said 401k quite a bit in this video. It's 401k, 403b, 457 plans. But again, you need to look at your particular retirement plan, because a lot of them are covered, but those same 401k, 403b, and 457 plans might also not be covered. And IRAs are covered too. So whichever type of retirement plan that you have, all you need to do is just ask your plan administrator, your broker dealer, ask your boss, ask the HR department. Whoever helps you manage the plan can give you the answer to whether or not this is something that you can actually do. And again, this isn't going to be right for everybody, but if you need access to more money and you don't know where else to turn, this could be an opportunity for you. And I just want you to understand the ins and the outs. If you have any questions, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.